Okay, welcome to this video on RSI. First thing you should know with all my educational videos is these are never scripted. I don't like scripted education. I like free-flowing education with just a discussion. So I'll try and keep the points as kind of tight as possible. Right, so I don't try and waffle on too much about other things. I'll try and keep to the point where possible. I want to go over today the basics of RSI, what I'm looking for in RSI, and primarily what we'll do for this video is we'll look for divergences. Okay, we'll go into more detail later on around RSI and other uses, but today's video is about divergences. So the first thing I want to cover off is RSI divergences are an indication of when the market is turning round. Okay, it's an indication of when we're seeing momentum from whatever direction, up or down, start to fade. And what we're looking to do is when we play into divergences, we're looking at taking advantage of when that momentum is turning and trying to get on board with that potential swing around in the price action. So what we're looking at is two things. Okay, we've got bullish divergences, which is where price makes a higher high and our indicator, our RSI, makes a lower high. Right, that's our first. This is the bearish divergence. Jesus Christ. Good start. So this is the bearish divergence. Price makes a higher high, RSI makes a lower high. And then what we get is the bullish divergence, which is when price makes a lower low and our RSI makes a higher low. Okay, so these are the scenarios that you get divergences in. You get a bearish divergence when we get higher highs and lower highs, and you get a bullish divergence when we get lower lows and higher lows. These are the two scenarios that you should be aware of. All right, hidden divergences I don't touch. Okay, I do not like hidden divergences. That will become apparent to you as we continue the discussions around RSI and its usage. Hidden divergences very often put you on the wrong side of the trade. They put you against the momentum that is actually coming through, and it usually causes you to ignore some very clear bearish divergences or bullish divergences when trading into them. So I don't like them, and we'll cover that off in more detail later on. So two types of divergences, bullish and bearish. And what we'll do is we'll take a look at now what structure we want to see for divergences and what we're looking for in terms of confirmation. Worth noting at this point as well that the RSI that I'm using here is always the standard. It's always default RSI, which is a 14-period RSI. When we talk about 14 period, what we're talking about is basically it looks back over the last 14 candles to produce the data set that we get from RSI. Which is why when we discuss the candle rule in this video, it will link back to that RSI description. So we're going to current action for BTC. I'll get a clean chart up so we don't have to worry about any mess on here. And we'll take a look at some of the current price action that we're seeing on BTC. So let's start off with a nice bearish divergence. Okay, a nice bearish divergence that we see. What one do I want to take? What's the cleanest one that I can see here? I mean, there's a couple along the way. I just want to see if there's any more that are better examples. I think we'll probably take this one here because this one is probably the best one that I have access to. It's easy to demonstrate and gets across the key points. So what we're looking at here is the higher highs and the lower highs in RSI. Okay, so what we've got here is a really, really clear and clean divergence, and we'll discuss what makes it that now. First thing to say is when we're mapping out divergences, we always use candle bodies. We use the candle closes to do so. Wicks are irrelevant to us when it comes to divergences. Okay, so no wicks are ever included in divergences because it's not how the data for RSI is produced. Right, so we don't want to use wicks because it doesn't form a part of the data. And one way of always confirming if your divergence is legitimate or not is making sure that you're swapping to a line chart. The div should be present on the line chart the same way it is on the candle. And it has to look the same on both because we care about the closes. Okay. So what we've got here is that bearish divergence. We've got the higher high in price up here, and we've got the lower high here in the RSI. Now, what's important about this particular region, let me just hide everything else for now so we can keep this nice and clean here. What's important about this region here is two things. Number one is the number of candles taken to form this divergence. So what we need is that the length of time between our first high and our second high does not exceed 14 candles. And we've already discussed why. Because our look back period is 14. Okay, so we need to make sure that the RSI itself is looking back at the right price points. If we start to extend over 14 candles, we'll come on to that in a later video, but it starts to skew things for us slightly. So what we're looking for is the first high and the second high to be formed within 14 candles. So on an hourly chart here, we know we've got around 14 hours of price action for us to potentially confirm that divergence or not. And what we see in this region here is a confirmation. Now, a lot of people always ask, what's a confirmation when it comes to divergences? How do we confirm that a div is a div? How do we know when it's locked in? And what we're looking for is we're looking for the RSI to turn away. And I'll show you why now. If I take this back actually a little bit more here, let me take it back just to this candle here. So what a lot of people do is they look at situations like this and they say, shit, looks like a div. Looks like a div here and here. And this is a classic mistake when it comes to RSI usage. Because what you are doing here is you are assuming that price turns around at this point. Because if you take a look at the position of the RSI, there's no reason to stop RSI going higher here. The market is aggressively moving upwards. There's nothing that really stops RSI from continuing upwards at the same time. So you see the way that there's no confirmation yet that price is going to go down, or it's going to turn around, or for what's important for us here, it's going to create that second high and start to turn away. Because right now, this is still, I refer to it as always price in action, right? It's moving. So we can't do anything with this yet because the price is still moving higher. It's still doing its thing. There's no confirmation yet that says this is where price is going to stop and turn around. So you're safe to enter a position here. Now if we progress here, see, you get this candle. And now that original div that you mapped out here and here is now looking really rough. Because you would have been stopped on this position. There's probably no way that you would have survived this if you were trying to play a nice stop on this. And you've now been taken out of your position. But what's worse is you're taken out of your position just before we do lock in the RSI divergence here. Okay, so you're stopped out. Now, what we've got here and what you can see that's a very clear difference is, look at this peak that's formed here on the RSI. So look at the peak that forms here. With this red candle, the RSI shifts back and locks in this high. So what we're looking for is always a movement back down or back up in RSI, depending on if we're looking at a bullish or a bearish divergence. If we're looking for a bearish divergence, we want to see the RSI move back down towards that 70 level and back inside the normal range of RSI. If we have the bullish divergence, and we'll look at that in a second, we want to see RSI tick upwards and head back towards 30 and back into that normal range of RSI. That's what we're looking for in order to say we've got a confirmation here that we're happy that this high is kind of locked in and that we may see movement away from it. I'll add this point in here, which is that typically we always want to take divergences that are operating within the extremes of RSI, which means that we want to be looking for bearish divergences that are occurring above the 70 level, and we want to look for bullish divergences that are occurring below the 30 level. We always primarily want to be operating in the extremes of RSI. Okay? So what we've got here now is our lock-in. We've got our confirmation, which means that we can enter a position. We're happy to enter in a position in this. But how do we enter positions in RSI? How do we enter positions utilizing this as an indicator method for us? Well, one of the things that we have to do in these situations is we have to think about, well, what happens if the div continues? What happens if we extend to the upside but continue to lose momentum? So what we need to think about is the way that we can position into this. And very often what we're looking at doing is scaling into an entry. So what I kind of, advocate for anybody using RSI is always take 50% of your entry on a confirmation of a divergence, like we've got down here. We take 50% of our entry here. And then what we do is we add into that once we get a confirmation that price actually wants to move lower. So we take our extra 50%, we bring our average down, and then we can slide our stop to a nice high. Now, the reason that we do that is because very often, and you'll see this in the future and in future videos, is that price likes to make another leg higher. We very often get triple divs. You may have heard them referred to as triple drives before, which is where essentially we make 3 legs, each one of the legs drops in momentum, and then we finally sell off. And so something to be aware of. Okay, we take 50% of position. The other reason that we take 50% of position at times like this is because whenever we take divergence-based trades, we are countering the trend. In the vast majority of instances, we're going counter-trend because now we're shorting Bitcoin after it's moved heavily to the upside. So you see, we have to protect ourselves there. We have to make sure that we don't just enter 100% of our position because we're trying to get into a move when price is starting to fail, right? Momentum's starting to fail. You imagine this like fighting, right? You're in a boxing match and you maybe sense that your opponent's getting tired and you can see that tiredness creeping in, but suddenly your opponent can hit you with that sucker punch, right? He gets that second wind and he comes back and strikes you, and you dropped your guard for a second, sensing the tiredness, and they capitalize. Exactly the same as price. Right? We're sensing the tiredness in BTC and its upwards move here. We're looking to try and counter that and get involved, right? Start throwing our punches. And we've got to be prepared that, BTC may have enough juice in it to get another leg out of this. So we're always better to take a smaller starting position and add on the way down when the trade moves in our direction. It's always the better play. So we see in this instance now, if I just take price forwards, what we start getting is a clear confirmation that we're now moving back inside. Price is responding. We can start to see where this goes to now. Now, the other thing to be aware of in a situation like this is very often is what we'll be looking for is how do we know when a divergence is played out? How is it possible to know when a div has played out? There are a couple of ways that we can try and do this, a couple of ways that we can try and sneak in some additional information. Now, a lot of this is going to come down to you and your testing, okay? It's going to come down to you in the way that you're going to be able to assess and analyze and want to utilize RSI. One of the things that we can utilize is we can utilize what we call end-to-end plays. And what we're talking about from an end-to-end play is we have RSI moving from the one extreme to the other extreme. And we can see it down here on BTC. This is an end-to-end move. RSI moving from the lower extreme to the upper extreme. Okay, we can see it here. RSI moving from the upper extreme down to the lower extreme. So now we can take that as our potential for divergences and divergence playouts. The other thing that we can do, and that's irrespective of time frame, by the way. I want to make that point clear, and I haven't done so far. This is irrespective of time frame. If you're utilizing this on a lower time frame, it's the same process. The other thing that we can do is we can look for any sign of momentum. So if you think about it, we're countering the trend, we're going against the trend and what the trend is saying, and we're looking at taking advantage of the weakness and the tiredness. And what very often happens in that weakness and tiredness is we look at attacking lows in an upwards moving market. So you can see with BTC here, that's a good example. So here, these are the lows that formed, and these are the lows that formed once the tiredness began. So we know that this is our divergence. We know that we've got a lot of price action here. We've got some lows here, and price moves down and takes out this low. We also saw a significant red candle, and I'm well aware this is black. We saw a significant candle down here, and that's enough for us to close our position. When we see significant moves, strong moves in the direction of our trade, that can be enough for us to close our divergence play. On the higher time frames, that might be different. When we get 3-day, weekly, monthly divergences, they can very, very usually indicate a trend reversal. Lower time frames, we tend to take the edge off any moves. Higher time frames can be full trend reversals. So let's play on and see what happens here. Okay, so at this point here, obviously we want to be out of the position. So what we've done is, in this, we can add in our third potential closing mechanism. What we've got in this situation is we can take our money on the impulse, which is very important to consider. And remember, all of these options are down to you. They're down to you and the way you want to trade and how you want to implement it. We've got our close based on the strong sell-off candle, or the strong buy-up candle if you're playing a bull div. We've got our close potentially based on RSI traveling down to the bottom. Didn't happen in this instance. And then we've got our close based on the RSI crossing back over the 50 level. And the reason that we take it on a close of and a break back above the 50 level in a short position is because that's where the momentum kicks in for the bulls again. So this level here, the 50 level, is a bull and a bear line. We're bullish above it, we're bearish below it. Right, so we want to see that bears continue to drive price down. They didn't manage to do that. We break back above, we have to close our position. Okay. So a couple of closing options in there for us. Let's exit this and we'll get back to current price action. We'll take a look at the action here. Let me just sort out my my FTX stuff. You know, just doing a bit of trading while we're recording a video. Okay. So that's the basis of the bull div, right, in that example. Now we've actually got quite a nice RSI div here on BTC for the hourly. And this was kind of a cool one because we had a discussion which was really, really good in the group yesterday. It was a really good discussion to have. So, you know, I won't name names, but we had a member who posted a chart and said, isn't this a div? And I said, well, wait and see. Wait and watch what the price action does and then come back and tell me what your thoughts are of it. So instead of me just saying yes or no, let's have an ongoing discussion around what we think the price action's doing. And it was right down at this cluster. Okay, so the individual in question was essentially looking at this and saying, well, from what I can see here, it's a little bit further on. Right, from what I can see here, we've got a div forming here and here. And this is that exact situation that I was referring to with the bearish divergence, which is where we can get into a position where we're anticipating too early that the div is developing. And like I said before, we can see here that the price action isn't done. We're not ready. We haven't confirmed that we're going to go back up. Okay? So we need to wait. We need to wait and see what the price action does. And I said that. I said in chat, wait and see what happens. And then watch what happens. Okay? Everything still looks okay. And again, you'd start to have a little bit of kind of maybe confirmation here at this point. We've now got a strong green candle and we've started to tick RSI back up. That's the sell. Okay, so the sell takes us through that level. And now we start to recover. But now we're in a position where things get really awkward. Because things get awkward now because we've got, well, this low here. But if we do it like this, then from this low to this low, we've got a div. But what about this? What about this here? Because actually, if we go from this low, this is actually a lower low. So actually, this is just continuation of the structure between here and here. So in these situations, this divergence is not clear for us. It is not a clear divergence. Okay, what we get from this is a strong move to the upside. We get a nice little bounce through here. But this is not a clean divergence, because you can see it gets awkward. Now, how do we avoid getting into this situation? Well, we can look at operating in the extremes. So like I said, we only look at taking trades once we're in the extremes of RSI. You know, we don't need to mess about with RSI when it's not in the extremes. It's not in the extremes here. We simply don't need to take a position. We just wait. It's just a non-trading situation for us. A couple of things to add to this. All right, I want to draw this out. I'm only looking at RSI here. So everything I draw here is just going to be RSI. Okay. If we are looking at bullish divergences, and the price action looks like this, right? The RSI looks like this. Small gaps between RSI, okay, small gaps here, as opposed to gaps like this, are poor divergences. Okay, these are poor divergences. What we want to see is a good amount of time passing between each of the legs on our divergence. So remember, we've got that 14 candle rule, and ideally we'd like to be up at 10, 11, 12, 13, 14 candles. We don't like tight divergences. They are very ineffective. Tight divergences like this, let's say this is the 1 hour time frame. Okay, let's say this here, this picture of RSI is the 1 hour time frame. I can almost guarantee you that if you went to the 15-minute time frame, your divergence would now look like this. Tight divergences are usually indications that the actual div is taking place on a lower time frame than what you're looking at. So when you swap from the hourly to the 15-minute, you will have a nice clean div to play. But what that means is, obviously, you need to be more aggressive because you're playing a 15-minute div versus an hourly div. So this is a more aggressive trade. Tight divergences, bad. Right? Poor setups. Swap to a lower time frame, good setups. But the reason they're good setups is because they come with different parameters. They come with more aggression in taking profit. They come with different levels. They come with different entries. Okay, I hope that's clear. Now, the other thing that we've got, and I'll do this again as a bullish divergence, is sometimes we see divs that look like this. Long divs, right? Really long divs. So we start to see things that look like this. And let's see, we've got this here. Okay. So we've got really long div on the 15-minute time frame. This is RSI. If you've got a situation where you've got these kind of triple divs or a long period of time where you can clearly see that higher lows are being made, swap to a higher time frame, because I can guarantee you that a higher time frame will look like this. All right. So what you'll end up doing is, this is the reverse of that example we just looked at. In this situation, when you've got long expansive divergences, switch to a higher time frame, because this is usually indicative that the play is relevant on a higher time frame, which again enables us to trade our setup, play a really strong hourly divergence instead of a 15-minute divergence, which once again changes our parameters, how long we can hold the position, what we might look for in terms of targets, and the way that we may assess from that point onwards. And you know, to further exemplify this, this is the 3-day BTC chart, right? This is exactly what happened here. So look at BTC chart here. Look, we can see the momentum dropping. Each one of these is a clear lower high, but it extends way too far to be a normal divergence. We swap it to the weekly, and what do we see? Far cleaner div. So you see the way that we change time frames. We identify that we can see something on the 3-day that looks like a divergence here because of the way we're losing momentum on each of these highs. So we go to a higher time frame. And there we see the cleaner divergence on the weekly. All right, that's the way we play this. That's the way we play these situations here. Let me see here, the daily. See if we can get this one. Let's go back to maybe here. Where's this div taking place? May 2019. Yeah, okay, so a really good example here as well on the daily. So we can see this high, and this high, they're all lower highs on the daily. So we can see those peaks are lower. We swap it to the 3-day. Okay, and we've got a very clear divergence here between this high. Here and here. Here and here. So you see the way we get those elongated divergences, either to the upside or the downside. And by swapping time frame, we get a far better picture of what's going on. RSI is all about learning how RSI functions, learning how divergences function. If you can do that successfully, then you will be able to integrate divergences as part of your system. Today's discussion is really an introduction to that. How do we start thinking about those divergences? What are we looking for? How do we determine a valid divergence versus an invalid divergence? And I've gone over some of that criteria today for you. Now, this will be the first in a series of videos on RSI and its utilization, because RSI is not just all about divergences. As I've said, RSI is a measure of momentum, and there's multiple ways that we can use momentum. We can use momentum to plan breakout trades. We can use momentum in order to determine where potential bottoms or tops may be forming. So we can use momentum and RSI for a whole range of things. It's not just divs, but today is a first taster into that world for you, and we'll cover off more and more as we go on in my time here. If there are any questions on anything that I've covered off in this video, then please just let me know and I'll be happy to answer those. And thank you for watching.